All right. What is up, traders? What's up, tycoons? Super excited for today's video. Another installment in the free trading course series that I have. Make sure to check out that playlist. I'm going from A to Z, covering what you want to start off with in the beginning and then progressing further into more technical details. So today's video is going to be on the simple moving average. We're going to start off defining it and then really head into how to combine it with multiple strategies, and it can really be a very useful tool. So make sure to smash the like button, subscribe to the channel if you guys are new, and we're going to jump straight into it. The simple moving average is the average of a selected range of prices, usually closing prices, by the number of periods in that range. Now, this is the formula for a simple moving average and calculating it, but you don't need to know the formula to know how to use it. But, if you are a math geek or a math nerd and you enjoy stuff like that, then, there is the formula there. Now, some of the key takeaways is that the simple moving averages calculate the average of a range of prices by the number of periods within that range. A simple moving average is a technical indicator that can aid in determining if an asset price will continue or if it will reverse a bull or bear trend. A simple moving average can be as enhanced as an exponential moving average, EMA, that is more heavily weighted on recent price action. Now, today's video is going to highlight the SMA, the simple moving average, and there will be a video in the future that goes over the exponential moving average. They are different and you would use them in slightly different ways. Now, some special considerations, okay, is that moving averages are an important analytical tool used to identify current price trends and the potential for a change in an established trend. The simplest use of an SMA in technical analysis is using it to quickly determine if an asset is in an uptrend or a downtrend. Another popular, albeit slightly more complex, analytical use is to compare a pair of simple moving averages with each covering different time frames. If a shorter term simple moving average is above a longer term average, an uptrend is expected. On the other hand, if the long-term average is above a short-term average, then a downtrend might be the expected outcome. A simple moving average smooths out volatility and makes it easier to view the price trend of a security. If the simple moving average points up, this means that the security's price is increasing. If it is pointing down, it means the security's price is decreasing. The longer the time frame for the moving average, the smoother the simple moving average. A shorter term moving average is more volatile, but its reading is closer to the source data. Now, something I do want to mention is that a lot of people like to trade different things, okay, whether it's cryptocurrency, whether it's Forex, whether it's commodities, whether it's stocks, bonds. You can use the simple moving average on a candlestick chart for all of those. So just keep that in mind. It's not something that only works on crypto or only works on stocks, etc. Now, one of the most popular simple moving averages is the 200-day SMA. However, there's a danger to following the crowd. As the Wall Street Journal explains, since thousands of traders base their strategies around the 200-day SMA, there is a chance that these predictions could become self-fulfilling and limit price growth. Now, there's some popular trading patterns, okay, that we're going to go over, but we'll give a brief description real quick. So two popular trading patterns that use simple moving averages include the death cross and a golden cross. A death cross occurs when the 50-day simple moving average crosses below the 200-day simple moving average. This is considered a bearish signal, indicating that further losses are in store. The golden cross occurs when a short-term SMA breaks above a long-term SMA. Reinforced by high trading volumes, this can signal further gains are in store. Now, these are some of the most common ones that people are going to use. We have the 20 SMA, that would be this red line right here, the 50 SMA, the 100 SMA, the 200 SMA, and the 300. So most people choose from one of these. There are a few others that we'll get into that you can use for some particular trading strategies. But yeah, these are some of the most commonly used. Now, an uptrend, okay? So remember we talked about you can use it to establish an uptrend. So here we can see that we're trading above all of the most common simple moving averages. And that helps you establish and identify an uptrend, right? They're pointing up as well. We talked about that. When you see them pointing up, it's indicative of an uptrend. Same thing for a downtrend. Okay, here we're trading below all of the simple moving averages, and we're continuing to head lower, right? So now we're in a downtrend. And that's being reinforced by the simple moving averages. They're all pointing down, indicating it's in a downtrend. Now this is a visualization of the death cross. Okay, so if you take a look, the death cross occurs right here where the 50 SMA crosses below our 200 SMA. And you can see at this point this is where the candlesticks are, and they do end up falling much further afterwards. Over here, we have the golden cross. This is a bullish crossover. We can see our 50 SMA crosses above the 200 moving average here. And what do you see? It indicates that things went upwards afterwards. Now, there's many different trading patterns, okay, that you can use. This is the 10 SMA and the 20 SMA crossover. So when they cross over, it's similar to golden cross and death cross. A lot of times it can indicate bearish or bullish activity. So in this case, we get the 10 SMA crossing above the 20 SMA. And what do we see? We see that we start an uptrend and continue that uptrend while we're holding those simple moving averages as support. Same thing happens over here for the bears, okay? So when the 10 SMA crosses below the 20 SMA, you can see that we end up starting a downtrend and heading lower in price. Another common one is going to be the 3 and the 8 crossover. So this is the 3 simple moving average, 3-day, and the 8-day, okay? And we can see we have our 3-day simple moving average crossing over, all right? And we start a bullish uptrend. Now over here, we get the 3-day moving average crossing below our 8-day moving average, and we start a bearish trend. These are going to hug the prices and, hug the candles a lot closer than the 10 and 20, all right? Now I talked about combining strategies together, right? So we've went over a couple different, moving averages, strategies, and, some of the popular ones. But now what we're going to do is we're going to combine supply and demand zones. So in my previous supply and demand tutorial, I gave over how to draw these zones, how to identify them, how to use them. But essentially a supply zone is going to be here in red. And this is a zone where there's an imbalance of sell orders, aka resistance, pushing the price lower. So now we're going to combine this with our 3-8 SMA crossover strategy, and this is on the 1-hour time frame. Okay, time frames are going to be very relevant and pretty important, right? You want to pay attention to the different time frames. So we're using the supply zone strategy, knowing that we're looking to take a sell order somewhere in between here. Okay, and we would have a stop loss roughly outside of our supply zone. And we can see here, we get our crossover shortly afterwards. The 3 SMA crosses below the 8 SMA. So, this can be your initial entry, or you can wait for multiple strategies to align together to give yourself a better entry signal. Right? It's better than using just one simple strategy than it is to combine strategies, right? Combining 2, 3, or 4 strategies and using those to give you signals for entries and exits is really going to increase your odds of success and help give you the edge that you need to be successful. Okay, trading is like going to battle, it's like going to war, and you need to have the proper weapons at your disposal and know how to use those weapons to increase your odds of success on the battlefield. So over here, we end up getting 2 signals. Okay, we end up getting our supply zone, and then we end up getting the crossover to the downside. And you can wait for the extra confirmation once we get the crossover instead of entering initially once we come up into the supply zone. As you see, we entered into it and then we continued up higher, and if you have a super tight stop loss on, you could have gotten stopped out of this play. So you get the crossover, and what do? We end up coming down into our demand zone, and then look what happens. We enter into our demand zone. This is an area where we're expecting price to push back up higher, and then we get the crossover shortly afterwards, right? So boom, we enter into demand, we get our crossover here, and we take that order back up into our previous supply zone. So that's combining, a couple strategies right there, supply and demand with the 3-8 SMA crossover. Now, this is supply and demand zones with the 10-20 SMA crossover, and this is on a 5-minute time frame, okay? So we can see, very similar thing. Okay, we're entering into supply over here, and we're looking to possibly take things short in our supply zone. All right, and then we end up getting a sell signal once we get the crossover down here. So we can enter our position here, put a stop loss towards the top of our supply zone, and really ride that momentum down until we get another crossover to the upside. Okay, so you can, you could have been able to ride that position from here all the way down to here, or you know, you can write it down into the supply zone or to the demand zone down here at the bottom. You know, whatever really fits your risk profile. You know, remember when the 10 SMA is crossing above the 20 SMA, that means things could get bullish. So you could always just close your position here and take those profits off of that trade to reduce your risk. Or, you know, you can set a stop loss around this area once you see the crossover. Set a stop loss at, you know, whatever your risk management, you know, allows, and try to let the play continue playing out and see if we come down into that demand zone. Now over here, we have the supply and demand zones with a 50-200 simple moving average crossover on the 1 hour time frame. All right, so this is going to be your death cross. All right, and so the 50 simple moving average is going to be here in yellow, and then we have the 200 SMA here in blue. All right, so we, you know, very similar things, guys. We're seeing that, you know, we end up coming into our supply zone. We get the 50-200 day simple moving average crossover. We come down, we get a significant pullback. Okay, and you can, you know, set a stop loss whenever the 50 SMA crosses back above, or you can set a stop loss, you know, at your 200 moving average, or, you know, you can just leave a stop loss above your initial entry, whatever your own risk profile is. But, you know, this is just showing you guys that you can use multiple time frames, multiple different, you know, SMA combinations to really, you know, find your trade. Now, if you look over here, we get a golden cross. Okay, we get the crossover to the upside, and then you ride that up into your supply zone, and you go ahead and take profits or set a tight stop loss in your supply zone, as there's a high likelihood of a pullback once you come into those supply zones. Now over here, this is going to be basically combining 4 strategies together, right? So we've all seen this meme, okay, or this GIF, whatever you want to call it. It's a pretty good one right here, but it's about, you know, using pretty much all of your brain. So boom, when we enter supply zone, right, you're using 25% of your brain. Then we get a candlestick pattern. Now you're using 50% of your brain. You're feeling good, okay? You're thinking you're Elon Musk. Over here, you get a moving average crossover, and you've taken the red pill and you see through the matrix, and then you combine volume, right? And now you are a trading god. Okay. Now, you know, that's just a little bit of humor there, but what we're doing is we're combining supply and demand zones with volume, with candlestick patterns, with the 3 and 8 moving average crossover. So same thing, we have our supply zone up here. We get a bearish candlestick pattern right here. This is a shooting star right here. I've made a candlestick, you know, pattern video as well for bullish and bearish candlestick patterns. So, you know, first thing, right, we come into supply, we're looking at possibly taking a short position. Number 2, we end up seeing that we get a shooting star. Okay, this is a bearish candlestick pattern, reinforcing our belief that we're going to end up moving downwards and price is going to move downwards. Shortly afterwards, we get the moving average crossover, and we see our 3 moving average cross below the 8 SMA. Okay, and number 4, all right, what do we get? We get volume supporting our thesis. So the way that volume works and volume by time works is you want volume to be in an uptrend for whatever trend you're trying to trade. So if the, you know, whatever it is that you're trading is going up, you want volume to be going up as well. And if it's going down, you want volume to be going up as well. That's going to indicate a strong trend. So after combining 3 things, supply, candlestick patterns with a crossover, we go ahead and we take a look at the volume, and we see, since, you know, that pattern started, volume was picking up. Okay, and it increased as our position was dropping lower, which is what we were looking for a move to the downside. And that just reinforces the whole theory of putting all of this stuff together, right? And so that's what the whole purpose of this free trading course is, you know, starting off with some of the beginning concepts, right? Candlestick patterns, bullish, bearish candlestick patterns. You want to start to be able to recognize those. That's going to help you out a lot. Then you start to learn a little bit about support and resistance, supply and demand zones, and then you start learning about volume and really combining volume. And now here recently, I've started using the VWAP. Okay, you can use the VWAP with those 3 previous strategies that I just mentioned. Now we're doing the simple moving averages, and we'll be expanding further into different technical indicators that you can use to combine together with multiple strategies. So that way you can, you know, feel more confident in your trades, have multiple signals rather than just one signal of, hey, we're at resistance, or hey, we're at support. You know, there's a lot of other things that you can look at and combine together to really give yourself an edge in the market. and increase your odds of success. So that's it for today's video. Hopefully you enjoyed it. If you did, smash the like button, subscribe to the channel, and check out some of the other videos in the free trading course playlist right here.